one of the things that I talk about is that we are a team first mentality. If you're not a nice person and you don't want to work in a collaborative team first workplace, this is not the place for you. We spend more of our lives at our workplace than we do at home. And so you want to do it with people that are committed and dedicated to the same vision and the same strategy, and they enjoy doing that together. And then you have a little success along the way. And, it ends up being kind of a perfect mix of you're working hard, you're having success, you're playing hard, and you like the people that you're doing it with. It just makes for, a more fulfilling life.
Prominent CEOs, leading economists, iconic investors, insights from the experts. The Walker Webcast with Willy Walker. See who's next.
It's really a pleasure to have Ryan Marshall join me today. Let me do a quick background on him, and then we will dive into talking about the housing market, which is obviously, Ryan, a hot topic in the both presidential election as well as where we sit today and looking into 2025. So I'm really looking forward to the discussion and super appreciative of you joining me. Ryan Marshall has been president and chief executive officer of PulteGroup, Inc. since September of 2016. Pulte is the nation's third largest home builder with operations in 26 states. The company serves all major consumer groups through its family of national brands, which include Pulte Homes, Centex, Del Webb, DeVosta Homes, and John Wieland Homes and Neighborhoods. Pulte's stock was at $20 a share when Ryan became CEO and is sitting at $130 a share today, an impressive 6.5 times return. Pulte's market cap has grown under Ryan's leadership from just over $7 billion to $26.4 billion today. Those are some impressive numbers, Ryan. I quite honestly, I thought I'd done pretty well at Walker and Dunlop, and then I read the numbers on you and Pulte, and I said, man, I got some work to do here. Let me jump in here. I got so much that I want to talk to you about as it relates to just the company, the way you're running it, housing markets, supply, demand, age of the average consumer, all sorts of stuff. But let's back up for a moment, Ryan, to when you came in as CEO. Elliott Management had taken a position in Pulte in the summer of 2016. And with the chairman of the board leaving and the CEO leaving, you were put in to be CEO. And I guess my question, you've been at Pulte for many years, so you weren't an outsider coming in to say, hey, there's a new sheriff in town. How was it to be put in as CEO, or if you will, the chief change officer at a company that you had been a senior executive at for 15 years before taking over as CEO?
Yeah, that's a fantastic question, Willie. And what I would tell you is, while I wasn't sitting directly at the table when Elliott came and approached us, I was certainly in a lot of the conversations behind the scenes. Our conversations were quite productive with Elliott. They came in, they sought to, understand our business model. They certainly had some things that they wanted us to achieve. I think when we articulated the plan that the management team was on, they generally agreed with those things. There was already a bit of a succession plan in place and a transition plan in place. So when I stepped into the role, I don't know that it was necessarily all that chaotic or that unforeseen. It probably happened a little bit sooner than maybe any of us were expecting. But really, what we did is we continued to focus on the playbook, focus on the things that we said we were going to do. And as a result, I think it worked out incredibly well for Elliott. I had many positive conversations with them, including the day I got the phone call that they said, hey, we've sold and we're out and you've done a great job. So that was certainly gratifying. In hindsight, maybe they wish they would have hung on for a little bit longer.
Clearly. When was that? When was that phone call when they said we're out?
That was in October of 2017.
Oh, wow.
Actually, no, I take that back. No, October of 2016. So it wasn't too much long. It wasn't too much longer after I became CEO. They called and said they were out.
Wow. I've heard you talk about a number of people who played a big life on you from a leadership standpoint. One of the ones that I didn't hear you say was Bill Pulte, who obviously founded the firm in 1956. How much had you worked with Pulte prior to his departure from the company. And obviously he had a role in working with Elliott to force the changes in leadership, both at the board as well as the senior executive team. But how much did Bill Pulte have an influence on you and your career at Pulte Homes?
Well, as you know, Willie, he was a true visionary and started this company, building his first home in Detroit, Michigan, at 18 years old. And, it's just the true American kind of entrepreneurial story. And he was a real visionary and leader in the industry. I met Bill for the first time in 2002, early 2002, in Tucson, Arizona. At that point in time, I just joined the company. I was down in our Tucson division, and Bill was doing a bit of a retirement tour. So, I met him as he came and he spoke to our division. I went to our corporate office the first time in 2003 to take a job on our asset management committee, our land committee. So I'd see Bill quite a bit in the corporate office when I was there as a member of our asset management team. And then, I'd see him from time to time. He was, he's a really big personality. He loved the business. He was engaged in everything. Where I probably got to know Bill the most was when I was the division president in our South Florida division, which we ran out of Naples, Florida.
And that's where he lived, right?
And Bill had a winter home there. And so, that's where I would tell you I really got to know Bill as a person. He would come into the office and he would want blueprints printed out from time to time. You always were excited by the phone call and also dreaded the phone call sometimes when our office manager would come and say, "Hey, Bill's on the phone." The conversation would typically go something like he'd been in a model. He had seen something that he either really liked or didn't like. And then you'd have a conversation about how you could make it better. So Willie, I relish and I cherish every moment that I had with him. I learned a ton. I was also fortunate to kind of sit down and have a really nice chat with Bill about 6 months before he passed. We shared a meal together up in northern Michigan. So just a tremendous individual, and we certainly miss him at the company.
I believe he had 14 children. Are there any Pultes in the company today?
No, not direct children. We've had some nephews and some grandchildren from time to time that have worked in and out of the company, but not any that I'm aware of today.
Start a legacy. Start turning dreams into realities. A better world begins with you. Better communities start with us.
You talked about meeting Bill for the first time back in the early 2000s. And one of the things that I found to be interesting was back in that period of time, Pulte was very focused on growth. Growth in the number of units you were developing and building and delivering, and then obviously the commensurate growth in EPS that you had. But in your last earnings call, Ryan, there's a graph where you backed up to the 2000 to 2005 period, and then the 2020 to 2025 period. And what I found to be so incredible about it is that you were growing deliveries that got up to, I believe, 48,000 deliveries in 2005, which if you look at where you are right now, you're at about 28,000, 29,000 deliveries on an annual basis. So you've brought deliveries down tremendously, but at the same time, you've been able to maintain EPS growth. I think your CAGR from 20 to 25 was somewhere around 38% compound annual growth rate on EPS. And today you're running at 36 over the last 5 years. How is it that you've been able to pull back growth so much, yet at the same time continue to grow earnings?
So it really goes back to a complete retooling of strategy that we undertook as a management team that started in like 2010, 2011. So we were kind of on the tail end of the great financial crisis, and fortunately, the company had survived barely. We went through some really, really tough times, and as a management team, we said there's got to be a better way to run this business. And so we did a deep dive, and out of that, what we realized is we had been a top quartile revenue company. We were at the time we had been the biggest company in terms of unit deliveries and in revenue, but we were fourth quartile when it came to return on invested capital. And the short story is the work and the analysis that we did said value is created for shareholders in housing by delivering high return on invested capital. And so we went on this journey and this path of completely retooling the way that we think about how we buy land, how we manage capital allocation, and the things that are important. Certainly, market share and scale are important. We have that as the third largest builder. We'll deliver 31,000 homes this year. We definitely pay attention to our market share because it matters. It allows you to buy more effectively, to get better deals with land sellers, to be a more attractive employer, et cetera. But the number one thing that we believe creates value, that drives some of the stats that you talked about at the beginning, taking the share price from $20 to almost $130 today, that value's been created because we've delivered high return on invested capital. So the way we operate, the way we think about things, the markets we go into, the way we invest capital, it's always with that North Star being return on invested capital.
So let's kind of double click on that a little bit. And I don't want to sound too much like an analyst here, but I'm fascinated by all this stuff. So I want to understand. So you're going to spend about $5 billion this year in acquiring land and building homes. So you're a company that uses a ton of capital to go buy that. And in, I think it was your Q2 earnings call, you talked about the fact that you're seeing low single digit inflation in your materials cost, and you're seeing low double digit inflation in land cost. And yet you continue to run the highest gross margins in the industry. So help me understand that, because you're talking about return on invested capital. You invest a ton of capital, yet you've got low double-digit inflation on land cost. And at the same time, you're also running these very, very healthy gross margins. Where's the magic in all that? Because if you just look at it on the face of it, it says, wow, that's a real trick.
Yeah, well, certainly we've as a company, we've prioritized gross margin over growth. They're both important, but we think that we get a bigger bang for our buck out of gross margin. What goes into that is buying communities in the right places, designing communities where the customers that come into those communities, they see value and they say, this is a place I want to be, and I'm willing to give you my hard-earned dollar to be in your community. We completely retooled the way that we think about home designs. We absolutely know that we're putting a better designed home on the market than our competition, and our consumers are seeing value in that. We've completely changed the way that we run our pricing strategy. So we're mostly, we've got more spec inventory today than we've historically run at, and I'm sure we'll get into that. But historically, we've been a built-to-order builder. The combination of how we buy land, how we develop it, the floor plans that we have, and the way we price, all of that has translated into an offering to the consumer where they see value, and we've been able to command a premium price. That premium price, combined with really efficient allocation of capital, you've got your numerator in the top of your income, and the denominator is your capital base, and the net result of that is your return on invested capital. That has been incredibly high, and we think that directly correlates. I don't know what the exact R value is, but it's really high in overlaying that return on invested capital with TSR.
So when I think about, you talk about the home you're building, I've heard you say that, design is at the top, then build quality. And then the final one is, you're very focused on net promoter scores and what your consumers are thinking about. And if you messed up on one or two, you're not going to get the third one coming in there. Talk for a moment about that, only in that. So I think it's helpful for people to understand what types of homes you're building. Your average home price last quarter was $548,000. So that's, and interesting. And we'll get in this in a second, but interestingly, the number of first-time home buyers has increased dramatically for you. And we know the dynamics that are playing there, but I'm interested as it relates to, let's stick on design and the building of the quality. How can you be so focused on design and building quality without watching margin degrade?
Sure. So, Willie, maybe I'll first start with, one of the things that makes us unique is the consumers that we serve. We're the most geographically and most consumer diverse national builder there. We have 3 distinct brands, starting with our Centex community, which is about 40% of our business, and that predominantly caters to a first-time entry-level buyer. 35% of our business is first move up and second move up, and that mostly comes under our Pulte Homes brand. And then 25% of our business is our active adult communities, which are predominantly under the Del Webb brand. There are a lot of really valuable brands, obviously, in the home building space. I think few rival the brand value and the brand equity that we get out of Del Webb. It really stands for something, and we're super proud to have that as part of our family of brands. As it relates to design, Willie, one of the things that we realized going back to 2010 or 11 is we needed to actually be a better home builder. And when I say that, a more efficient home builder that runs more like a manufacturer, a really efficient manufacturer, as opposed to a custom builder. Certainly, there's plenty of custom builders out there that do really well, but it's hard to do that on a national level. So we started thinking about housing at a national level the way a manufacturer would. And one of the most important things for a manufacturer is throughput and efficiency. And we started studying the number of times that we built individual floor plans, and we realized that our throughput was atrocious. Sometimes we were building, we had like 3,500 different floor plans that we were managing. You're managing the cost and the engineering and the specifications. And on an average, we were building those homes like 4 times each. Terribly inefficient. And so we started a project called our commonly managed plans. And the goal was to take those 3,500 floor plans down to about 500 and then build 80% of our deliveries out of those 500 floor plans. And there's been a lot of things that I think have contributed to our success, but that single-handedly has probably been one of the biggest unlocks because number one, we've gotten a ton of value engineering. The behind the walls engineering, the amount of material and the truss layout and the truss design and the HVAC runs, all of those things have been optimized. And so we've got really good building costs. The other thing that we did is we really got into the mind of the consumer and we said, hey, it's interesting what we think. Yeah, we're home builders. And yes, this is our field of expertise. But what does the consumer want? We had a board member, Tom Shoei. Tom was the former CFO of Walmart. And Tom always preached, you've got to get inside the head of the consumer. And so we started this mantra around being consumer inspired. And we would go and we would rent out 75,000 square foot warehouses. And inside those warehouses, we'd take a potential floor plan and we would build it out of 2x4s and paper walls and put fake furniture in this home. And so when you walked into the home, you felt like you were walking into a model home, but it only took us a day to build. You'd walk a consumer through it, and then we'd sit them down in a focus group and say, what works, what doesn't work. And then we'd use that feedback to quickly refine and iterate the floor plan. And the next day, you could walk the same consumers through the updated floor plan. And the net result of that is when we actually went and built the house for real, you had an unbelievable floor plan. And that methodology and that discipline still exists in the company today. And it's one of the big unlocks that I think we have that allows us to put better designs on the ground.
As you talk about that shift in the, if you will, the simplification or the rationalization of the floor plans and everything that goes into it, it makes me think about technology. And, we both know about Katera, which was a pretty high-flying modular builder that crashed and burned quite famously. Anything happening in the home building space as it relates to modular or printed homes or things of that nature that people ought to be thinking about today? I was talking to Stuart Miller about this issue probably about a year ago, and I said, Stuart, anything going on? And he said, look, we're trying to invest everywhere, and we've got a lot of technology that we're trying to put into it, but there's nothing as it relates to a major kind of disruptor to the single-family home industry that we're either invested in or implementing today that's going to materially change the overall cost of either construction or delivery. Where are we a year later? Anything, Ryan, that's going to materially change this industry?
Boy, there's there's a lot of activity, Willie, and I know Stuart well, and Stuart and I spend a fair amount of time together working on industry things. As you know, this industry is really collegial and really works together on big industry problems. It's one of the things I love about the housing space. We're fierce competitors, obviously, but I think we work together on the right things. As it relates to innovation, the industry needs to do more and needs to do better. If you look at over the last 40 years, housing is probably the one industry that we haven't seen significant gains in labor productivity. We're still basically at a factor of one, where if you look at every other major industrial industry, there's been progress in labor efficiency. So I think we need to continue to put investment toward it. Speaking for us specifically, we've done a couple of things. One, we've made some pretty big investments in some of the prop tech funds that are directly out investing and incubating in various technologies. And the idea was, hey, we want to have a seat at the table. We want to have first access to some of the technology. And if we can use it to make our homes better, make us more efficient, then we will. And we've gotten some small wins. We've also made some direct investments into a couple of unique, neat companies. One that we're probably most excited about is an HVAC distribution company called RIA. And instead of distributing heat and air through, the great big giant pipes that run through unconditioned space in the attic, you can run it through small tubes that go in between the walls in conditioned space. So way more energy efficient, takes up a lot less space. So we've made some direct investments into companies like that I think are innovative and will definitely pay dividends. We've also we've got two of our own offsite manufacturing plants where we're building floor cassettes, wall panels, and trusses. We're using a bunch of technology, 3D modeling, robotic saws, robotic nailers, robotic material handlers. We get a lot of efficiency out of that. And we think we're just at kind of the tip of the iceberg of what can eventually happen in terms of building components in a factory. Building an entire modular home in a factory, you can get super efficient, but 90% of what you're transporting down the road is air, and it's really expensive. So we think by making some investments in components, you can transport and distribute them, much more efficiently. All that said, Willie, I'd agree with Stuart. There has not been any kind of major breakthroughs yet, and we need to find it.
As we talk about home affordability, it's been a big issue. Political campaign just had a lot of talk about both inflationary pressures as well as the cost of housing. I have to say there was one thing that I don't think the Harris campaign articulated very well as people talked about the lack of home affordability, which is that 65% of Americans actually own their home. 80% of them have a fixed rate mortgage on it, and that asset has appreciated over 50% in the last 4 years. And so for most people's largest asset growing over 50% over the last 4 years is actually really good for them. And they never figured out how to sort of spin that as it relates to the value of that asset going up and therefore being able to do other things. But I want to talk a little bit here about the where the market is going right now, given higher cost of financing. You all have done a fantastic job of continuing to move through your inventory by putting rate buyback downs in. I think you were at a 5.75 30-year fixed rate mortgage last time I checked. And obviously with mortgage rates over 7%, that's a significant discount to someone coming in. And that's also in your gross margin, which means that you're being able to keep margins high as you're buying down those rates, which is absolutely fantastic. But to the first-time home buyer versus the move-up home buyer, that mix has changed dramatically over the past couple of years. And I'm curious whether that's just due to the cost of housing or whether it's due to that time in one's life when they want to actually go buy. So you've gone from 31% of sales going to first-time home buyers in 2020 to 41% year to date. So a very significant uptick in first-time home buyers. And then as a result of that, and your active seniors have stayed basically stagnant, which means that your move up sales have come down commensurately from 45% in 2020 to 37% today. Talk about what's making that first time home buyer be able to transact and how important that is versus the move up buyer that you typically were focusing on much more previously.
Yeah. So, Willie, those number one, your research team is unbelievable. Thank you for having all the stats handy. It makes this conversation super easy. What I would tell you is the shift when we went from 31 to 41%, that was deliberate. We made a decision about 6 years ago to say we want to index our business to what we believe the size of the prize is, And in most markets, about 40% of the transactions that happened were first time. And so we deliberately set a target to say that's what we want our business mix to be. Land's a very long cycled business. So, what we started 6 years ago in starting to buy more land that was specifically purposed and intended for that first time buyer, you're seeing that come through the revenue line in our mix of business today. So it's been very intentional. And every builder makes decisions on what they want their mix of business to be. One of the things that we like about our strategy is that we never have all of our eggs in one basket. And most housing cycles, at least healthy housing cycles, they have participation from every consumer group. And depending on what's going on in the broader economy and the job market, those different buyer groups will behave in slightly different ways. Sometimes the first time's the hottest, sometimes the move up's the hottest, sometimes it's active adult. We like having the diversified portfolio, maybe not too much different from somebody that's investing in the stock market that wants, a mix of stocks. They want a mix of bonds. Maybe they have some mutual funds, but they've got exposure to the full market. We think that's what we have. What we really like about, and I'm gonna talk about all three consumer groups. What we really like about the first time buyer, they don't have a home to sell. So by definition, it is their first time owning a home. There's still incredibly high desire to own a home, which we think is great for the industry. But they're not sitting on a sub 3% mortgage rate that they don't want to let go of. And so candidly, the biggest challenge that we have with the first time home buyer is affordability is strained. But we're using that really powerful incentive of mortgage rate buy downs to help that buyer get into their first time home when they're ecstatic. The move up buyer has actually been our best performing group over the last couple of quarters. And we think it's because of what you highlighted. They've had tremendous wealth accumulation in the value of their home. And there's been such low inventory on the market. If you've got an existing home, it's well built, it's well maintained, you put it on and you put it on the market at a reasonable price, it sells quickly. And then they're able to take that equity and they're able to go do something else that they want, a bigger home, different part of town, something nicer, more expensive or newer. And we're able to help that buyer with mortgage rate buy downs as well. So there's a lot of nice things going on there. And then, finally, the active adult consumer, that's a buyer group that is in most cases building the last home that they'll ever buy. They've got a tremendous amount of wealth, both from being a homeowner, but also from doing incredibly well with their investment portfolio. And they come to the table and they buy the things that they want to buy. If they want the best lot in the neighborhood that's on a cul-de-sac that backs up to a lake and a golf course, they're willing to pay for that. And it's part of the reason that we have been able to maintain high margins in the entire company is because of the outsized margin contribution that we get from our Del Webb business.
All super interesting. I've got two slides that I want to share here, Ryan, and if I really mess this up, I don't usually do this, but I want to show them because the data is so interesting. So let me see if I can pull these up and you can see them. This one I just saw today, which was the characteristics of home buyers. And as you can see on this slide, the average age of a first-time home buyer right now has gone up to 38 years old from what has been a historic average of 31 to 32 years old. So we're seeing this significant uptick in when people are actually buying their first home. And then the second one, this won't surprise you at all, but this is the Wells Fargo Home Affordability Index. And as you can see on this one, for anyone who's listening to this on a webcast rather than watching the slides, this shows that if you go back to 2014, the median home price in America was affordable to someone making the median income for about 66% of Americans. And this graph just shows that as it has gone along, it stayed pretty consistent until about 2021. And it has just fallen like a rock. And it's now at only 40% of people being able to afford a home in America if you make the median household income. So if you look at those charts and you think about it, with the average consumer getting older and older, and the affordability index being down as low as it is, how do you deal with that from a home building standpoint as it relates to both what you're building and what your expectations are from a volume standpoint?
So two things that I'd highlight, and I think they're correlated. we've seen changes in behavior from, the adults. I was going to say kids, but they're not kids anymore. But the typical home buyer that was maybe in their mid-20s or late 20s that is now into their 30s. I think some of that is societal change. People are getting married later. They're waiting longer to get married. They're waiting longer to have kids. And so by kind of definition, I think everything shifted 4 or 5, maybe even 6 years from what it used to be. I bought my first home when I was 24 years old. My oldest son is now 24 years old. I can't even imagine him kind of thinking about buying a home at this point in time. And I think it's
but hang on a second. You bought your first gas station when you were in college. So, so comparing what you did as far as buying your first gas station in college versus your son not buying his first home. I don't know that that's a fair comparison, Ryan, but anyway, keep going.
I did have a good time with the gas station. There are a lot of stories there. So I think things have shifted there for sure. The other thing contributing to the shift in the age of when people are buying their first home, I think goes to the second chart, which is things are more expensive. Affordability is so pinched right now that I actually think people are having to wait longer to save more money, get more established, to get further along in their career so that they feel like they've got the financial stability that they can make the commitment of buying a home. The unlock here, and I'm sure we'll get to this, we need more homes in this country. We are so chronically undersupplied with housing, Willie. There were a lot of things about the recent presidential election that were tough to watch. Just the vitriol and kind of the back and forth and the divisiveness between, the two campaigns. It was hard. It was hard as an American to watch it. I'm grateful that we're kind of on the other side of it. We can kind of get back to business. One of the things that I was really encouraged by, though, was the fact that both campaigns, both Vice President Harris and President-elect Trump, were both talking about the need for more housing. They're going about it or suggesting that we go about solving it in different ways. But it's the first time that I can remember as an adult that there's been that level of conversation about housing supply and housing affordability. And I think that's a net positive for the country.
When you hear Vice President Harris talk about the need for 3 million new single-family homes, other than that's pro-growth, which is great, and that's the only way we're going to bring prices down. Talk for a moment about the sizing on that. The single-family housing industry and multifamily are delivering about 1 million units a year. She was calling for 3 million. You and I both remember the great financial crisis when we got a little oversupplied as it relates to single-family housing. What's that sweet spot, Ryan, as it relates to if you're delivering 30,000 homes a year, what would you need to raise it to? What would the rest of your large cohort have to take it to get to a point where we were delivering enough housing to start to make a meaningful dent in the cost of housing?
So the number of homes that are needed in the country, it's fiercely debated, but the number that we typically anchor a lot of our long-term planning around is the country needs 1.5 million homes a year. That's inclusive of for sale and for rent. Traditionally, half of those, or 750,000, were for sale. Half of those were multifamily. We've been underbuilding that 1.5 million number for the last decade, maybe even going on 15 years. And we believe that dynamic has created the housing deficit that we have today in the country, which I think is at least several million. There are estimates and numbers out there from different economists and different governmental agencies that suggest the deficit of housing ranges from 2 million all the way up to 7 million. I tend to anchor somewhere around 3. Ironically or coincidentally, that is the same number that Vice President Harris was talking about as well. The short story is, Willie, we need more houses. And if we're only building 1.5 million a year and we've got let's call it a 3 million unit deficit, we've got to build a lot of houses for a lot of years. And we've almost got to oversupply the 1.5 million per year need in order to catch up. If we could supply a little bit more and both single family and multifamily, I think that would probably be the single biggest and most powerful tool that we could have to bring down prices and make affordability or housing more attainable and more affordable for more buyers. Now, the trick is as a country, we're a not in my backyard population. And so everybody loves the idea of growing the economy, growing more jobs, until it relates to putting new development in or next door to you or across the street from where you currently live. And then all of a sudden we become anti-growth. Until we figure out how to solve that as a country, I think we're going to continually and perpetually have a chronic undersupply of housing.
It's interesting because those numbers, everything you just ran through, all resonate well. They're numbers that I've seen and think very similarly on. If you look at the multifamily industry, we've got about 600,000 units delivering in 2024. So there's a massive new supply, which has put downward pressure on rents, but you're still going to get 1.5% to 2% national rent growth this year, even with that huge amount of new supply. But then you look at the forward pipeline on multifamily, and it's dropped down to 250,000 units right now that are under construction to be delivered in 26 or 27. And so it's really interesting, Ryan, because unless something changes materially where either you say, I'm going to go from building 30,000 homes a year to building 45,000 homes a year, and all of your cohort companies also do that, we're going to find ourselves back in an undersupplied housing market in 2026, which is going to push rents, it's going to push prices, and we're going to be back with the same inflationary pressures in housing that we have just started to work ourselves through as we've had this big supply of both single family as well as multifamily. And it all seems, if you will, quite short-sighted. There are plenty of investors that are in the multifamily space that are chasing exactly that, if you will, setup, which is home affordability is at an all-time low, making it hard for people to go out and buy your homes. And at the same time, you're oversupplied in multi today, but you're going to be undersupplied in 2 years. Therefore, it's a good time to buy now and ride through that wave. You see anything changing on that kind of dynamic?
I don't, Willie. I think we've all got a lot of land under control and in the pipeline, but there's a limit to how much land can be brought online in any given year, mostly controlled by local municipalities. So as encouraged as I was by, the conversation around housing as a federal level, we've got to get that to trickle down to the state, and more importantly, the city and municipality level. In the way land zoning and land entitlements work in this country, it's controlled by city councils. That's dependent on schools. It's dependent on availability of sewer and water and roads. And that infrastructure is old. It needs more investment. It needs repair. And, there's a number of constraints that make it tough to bring on a whole bunch more than what we're currently building. Now, we've talked about our company. We've got the ability, based on the land investments that we've made and what we have in our land pipeline, of growing our deliveries by about 5 to 10% a year. We're really optimistic about what our company can continue to do. And several of our national peers are talking, very similar numbers. So I think certain players within our industry can deliver more, but I'm not sure that the industry as a whole, including, the really small, single market builders, I'm not sure that as an industry as a whole, we deliver much more than the 1.5 million in total. And to your point, and I 100% agree with you, we have a massive gap in multifamily deliveries coming in 2006. And that gap started, or that air bubble started, when interest rates went up. The multifamily developers simply couldn't make their deals pencil, and so they stopped putting new deals in the ground. That is absolutely going to put a pinch on the consumer. It's going to keep prices high because supply is low. And I think the net result of that is the industry will, in an odd way, benefit from continued higher margins and higher prices. I don't think it's necessarily a great thing for the country. And that's why I think we all need to work together to make sure that we're putting, the right influence on local leaders to say, as we're growing the economy and we're creating jobs, we also have to create new homes to go with it. I always like to tell my politician friends, as you create new jobs, you have to create new homes to go with it. By definition, a new job is a new person, and that new person, a new job, needs a place to go sleep at night, and that's a new home. And so if we can think about how to balance all of the growth objectives, I think we'll have a healthier economy.
You have a market research group, Ryan, that studies markets and figures out where you all are going to both buy land and then build homes. I was interested that three of your new markets are Denver, Salt Lake, and Portland. And I live in Denver, and you love the great state of Utah. And so that makes sense to me, both because there are great demographics in both Denver as well as Salt Lake. I was surprised on Portland. I went out to Portland a year ago and gave a speech out there, and I basically put up some slides as it relates to the lack of development in Portland because of local government and all the things that you and I just talked about. They didn't quite throw tomatoes at me on stage, but I don't think they were really happy with my sort of tone, which was just, if you all want to get investment to come to Portland, you all need to make some changes locally to make it a more investor friendly place. Why Portland? Just because none of the multifamily developers are there for all the reasons that I just talked about, and therefore there's a real opportunity for single family?
Yeah, we saw it as an opportunity to build, a 400 to 500 homes a year in Portland at a minimum, maybe more. And so for that reason, it was attractive. We weren't there. It's definitely on the list of top 50 major housing cities in the United States. As you know, there are a lot of big companies that are based and headquartered in Portland, and those employees of those big companies need places to live. We also saw it as an opportunity that we could leverage the skill set and the expertise of our team in the Seattle area. That's not too far of a drive for that team to reach down into Portland. And we felt like that we got some nice economies of scale by leveraging the operations between those two cities. So, we don't see it as probably as the fastest growing market where we operate, but it was definitely a place that we felt like we needed to be.
One of the other things that I find to be interesting about your industry, Ryan, is just the massive consolidation into the large public home builders. The economies of scale that you're getting, the ability to finance new home buys. I don't have the stat, but Ivy Zellman told it to me at one point. Just there's been a huge migration, if you will, from a lot of smaller regional developers into the large national developers. And as I think about that, I wonder whether M&A for you is something that is still out there. I went back and listened to your earnings call in 2019 to just kind of get a sense of the tone pre-pandemic, because obviously everything has changed dramatically in the housing industry since 2020. And you'd made an acquisition that quarter, I think it was Q4 2019. Was that the last acquisition you've done? And on the backs of that are you looking at just organic growth now, or is there the opportunity to continue to consolidate the industry?
Yeah. So, number one, Willie, if Ivy gave you the stat, I'd believe it. I'd take it to the bank. She's as you know, and a real friend of the industry. We've got the view and the philosophy that M&A will always be part of things that are on our radar screen. There has been massive consolidation, and if you look at the top 50 housing markets in the country, for the most part, the top 10 builders in those markets have somewhere between 70 and 80% market share. If you compared that with 15, maybe even 10 years ago, the concentration inside the top 10 builders in a top housing market was not that high. So there has been consolidation, and more of it is concentrated within the top 10 builders. As a company, we've done big M&A, Del Webb, Centex, John Wheeland, those were bigger deals, sometimes mega deals. We've also done things like Dominion Homes, which was headquartered in Columbus, Ohio. That was our, and they had a few other markets there as well, but predominantly Columbus. That's how we got into Columbus. And then the 2019 acquisition that you mentioned was American West in Las Vegas. And all the M&A that I've been involved with directly or around, it's the single market or maybe double or dual market or triple market type M&A that I think makes the most sense. It gives us the ability to get into a particular part of town, which we got in the American West acquisition. That builder had a dominant market share in the southwest part of Las Vegas, which we weren't there. But their land holdings and the things that they owned and controlled gave us a phenomenal added element to our business in Las Vegas. So I like those types of acquisitions a lot. As you can imagine, given our size, we see a lot of deals. Our M&A team, our treasury team, we're always talking to the investment bankers, seeing what's out there. But we know that we can grow organically just as effectively and maybe even more effectively. We're choosing exactly the places that we want to be and the deals that we want to do. Where if you do an M&A deal, you inherit a lot of stuff. Some of it you'll like, some of it you won't. I've often, joked a little bit with investors that M&A is a little bit like the old Forrest Gump adage of life's like a box of chocolates. Sometimes you're going to like the chocolate, and sometimes you aren't. And you avoid that when you can grow organically. So there's a role for it, but given a choice, I'd rather grow organically.
Tariffs. It's a topic that's come up a lot, both during the campaign. Now that President Trump is President-elect Trump, everyone's sort of bracing for what the impact of tariffs could be. And I think, at least on my side, it's what it could do to financing costs and where interest rates could go. That obviously has a big play on your business. One of the tariffs that the Biden administration kept in place was a pretty hefty tariff on Canadian lumber. How much has that impacted the housing industry? And would you like to see that those tariffs go away, or is having the protectionist tariffs between the United States and Canada protecting the U.S. lumber industry, which net has worked itself out? What's your take on that? There's one of those specific ones, Ryan, that everyone's kind of talking about. Oh, what if tariffs on China go from 20% to 60%, what have you? But that one on Canadian lumber has been a pretty significant tariff and kept the cost of operations as it relates to lumber, which is obviously one of your key raw materials, at a pretty elevated rate over the last 4 years as the Biden administration kept that in place.
Yeah. So if we went back 18 months ago when, the random lengths pricing for lumber was at an all-time high, in fact, highs that I don't think I ever remember seeing in my career, it was painful. Today, lumber prices are maybe not at all-time lows, but they're pretty manageable. And lumber prices have actually been a tailwind for us over the last 12 to 18 months as it relates to our house costs. So, the tariff, the philosophy around tariffs is complicated and tricky. And I'm going to try and stay in my lane and not get out on the skiddy branches around tariff philosophy. We do think about the impact of our business, obviously. As it relates to China and China tariffs, we're certainly in a global economy. The good news is most of what's in our homes is domestically sourced or domestically produced. There are components of certain things that go into our homes that certainly come from China and other countries that will be impacted by tariffs. We're paying attention to it. We're watching it. My hope is that as we think about kind of tariffs and the impact to affordability and interest rates, that there's not one single industry. We don't over-index to one single industry, and that we think about what's best for the American economy and the American people.
And as you think about leading over the next 5 years, Ryan, you've done an incredible job growing this company. And what was it? The number I used previously was almost doing 4x in market cap over your tenure as CEO. What's the exciting thing? I know you plant a garden on an annual basis. So if you think you're planting a garden at home and those flowers are going to come up in the spring or the summer, the gardens you plant at Pulte have a little bit longer gestation period. What's the exciting thing you're planting at Pulte now that we might see come up in 5 years or so?
Well, Willie, I did recently plant some beet seeds. I love beets. I love beets and beet salads. I planted some beets. I failed to water them because I went out of town for a few weeks on some work trips, and I'm not going to have any beets this winter. So we're going to make sure that doesn't happen at Pulte. The thing that we really focus on is making sure that our land pipeline is something that is full and stocked and programmed out into the future. The lifeblood of any home builder is a good land pipeline. We're in an unbelievable position. We have 230,000 lots that we control. Of that, about 55% of those lots we hold under option. So the thing that I'm most excited about is that we have the opportunity to continue to grow this company in a meaningful way. I'm really excited about that. It'll be great for our shareholders. It'll be great for our employees. One of the things that's been so gratifying to me as an employee of this company and in this industry for almost 24 years is that as the company grew, I had opportunities to grow my own career and do more neat, exciting things. So, going into Denver, going into Salt Lake, going into Portland, and a handful of other new cities that we've gone into, that creates more opportunities and more career opportunities for our employees, which is exciting. It's also really exciting for our investors because we'll continue to grow this company and we'll continue to operate it in a way that's going to deliver high return on invested capital, which we think creates some real value. I'm also incredibly excited about the culture of this organization. Pulte is an unbelievable place to work. It always has been, and it's as good as it's ever been. For the fourth year in a row, we've been recognized as a company as a top 100 best company to work for by Fortune magazine. And it's because of years and years and years of investing in our people. I've got an unbelievable management team. We've got an unbelievable group of division presidents, and we've got 7,000 employees company-wide that bring the best version of themselves to work every day. Not only do they love being here and working with each other on a team, they're incredibly committed to our customers. And that feeds back into that philosophy of doing the right thing, which goes back to an original Bill Pulte tenet. It's something that we still live and breathe here in the company today. And we take care of our customers, which translates into that kind of philosophy around net promoter score. So, what am I most excited about? Life in general. I love kind of what we're doing. I love kind of being alive. I love this industry. And, the growth opportunity of the company is really exciting as well.
Yeah, look, I hear what you just said, and having studied your company, know that it's all true. And at the same time, I would say that it's because you say things like that that make your leadership so unique at the company and get the team doing what the team's done. I mean, I started this conversation saying in 2016, there was an activist shareholder who pushed out the CEO, who pushed out the board chair and brought you in as the agent of change. And while clearly the macro environment for the home building industry has been fantastic post-pandemic, those numbers that I talked about, I mean, your TSR, Ryan, I looked at it, your TSR on a 1, 3, and 5-year basis, you're number one in the industry on 1 year, you're number one on 3 years, and you're number 3 on 5-year TSR. I mean, that takes a lot of work from your team to be able to put up that type of total shareholder return. And a lot of it comes from the way that you're leading the organization. I mean, you mentioned great place to work. At W&D, we've looked at we have been a great place to work. And as I typically say, it's the most important metric, but it's very evident that that's what you've instilled into the company.
Yeah, I often, we have a really robust training program, Willie, where we bring all new hires through a training program here at our corporate office in Atlanta. I normally go down, as long as I'm in town, I go down and I spend a few minutes with those new hires, welcome them to the company, and I talk about our core values. One of the things that I talk about is that we are a team first mentality. If you're not a nice person and you don't want to work in a collaborative team first workplace, this is not the place for you. We spend more of our lives at our workplace than we do at home. And so you want to do it with people that are committed and dedicated to the same vision and the same strategy, and they enjoy doing that together. And then you have a little success along the way. And, it ends up being kind of a perfect mix of you're working hard, you're having success, you're playing hard, and you like the people that you're doing it with. It just makes for, a more fulfilling life.
You mentioned your Atlanta headquarters. When I was looking at when Elliott came in and when your predecessor left the firm, one of the things that Bill Pulte was not happy with was that the headquarters was moved from Detroit to Atlanta. Any chance Pulte finds its way back to this? What is it? Detroit's not the Iron City. Pittsburgh's the Iron City.
Motor City.
Yeah,
the
exactly. Motor City.
Yeah, well, look, Willie, I lived in Detroit for a brief period of time. My middle son was born in Detroit, and I really enjoyed living there. It's a great place. I also enjoy living in Atlanta. We've been here for 10 years, and fortunately for me, I wasn't involved in the controversy around making the decision to leave Detroit or stay in Atlanta. We're here now, and as you know, the cost of moving company headquarters is tremendous. And I think that was one of the things that our founder was critical of, was the amount of money that was spent to relocate. So we're in Atlanta. It's a great city for business. The state of Georgia is a very business friendly, business first state as well. And we've got a ton of investment in kind of the Southeast Sun Belt part of the country. So I think we're here.
My final question for you, Ryan, and you've been super generous with your time. I know as a kid, because your dad was a vet, you always wanted to grow up and be a cowboy. When do we find you out on the range in Utah with a couple thousand acres of land and riding around on your horse?
Well, my wife often reminds me, I sometimes say, I'd love to have some chickens at home. And she's like, you're not home enough and I'm not feeding your chickens. So no chickens.
She's also not watering your beets, obviously. So
right, exactly. I need to automate that, Willie. I should be smart enough to put in an automated watering system. But look, I did grow up in a rural part of Utah. My dad was a veterinarian. At one point in time, we had about 2,500 head of beef cattle. And so, that lifestyle and some of those things, not only did I learn the value of kind of work ethic and of living kind of off the land, from my parents and living in that environment. It's something that I enjoy. I've got a very different life today, doing what I do in kind of this business. And I'm sure there'll be a time and a place for all of it, but I probably need more time before you'll see me riding around on a horse chasing cattle.
It's great. I'm sure the shareholders of Pulte are very, very happy to hear that response from you. Ryan, it's been a real pleasure. I'm super appreciative of your time. Let's go make some turns together. I'd love to get together this winter and go ski some. Thanks very much. And thank you everyone who joined us today.
Thank you, Willie.